Hello class, this is Dr. Fenton. Let's take a look at Chapter 5 today. So let's remove my video, get it down here. Okay, now Chapter 5, External and Internal Fraud, Misappropriation of Assets. Let's go ahead and jump to page number 3, right here. And just to see the effect that fraud might have on a business, let's look at this example I have highlighted. Let's say employee fraud reduces the bottom line by $100,000. This is your net income, and you have $100,000 worth of theft that's hitting your bottom line. If the company has a 20% profit margin, then the company must generate $500,000 in revenue to offset the lost income. So that shows you what an impact that fraud can have. It will hit your bottom line, and then to get back where you were before that loss, you'd have to sell a lot more in revenue than just the loss that you incurred. Let's scroll down a little bit, and let's look at some non-cash damages from fraud. So besides the dollars you might be losing, what else is happening? Well, employee morale can be hit. You can see the effect there. Business relations, with other businesses and so forth. The organization's reputation. If the word gets out, like if there's a court case or hits the news, and you find out the company was involved in fraud or someone in the company was involved with fraud, that can hit the reputation. And you can see a few others here. Go to the next page. And let's see. Now let's talk about employee fraudsters. So people inside the company, and in one fashion or the other, they are stealing from the company. It could be cash, could be inventory, a variety of things. What are some of those fraudsters' characteristics? You can see a list here. Egotistical, they are risk takers, hard workers, greedy, and you can read the others. So I guess that would sound about right? And there's another list you can read through. Now I want you to look at this. A Kessler study shows that 13% of employees, 13% of employees are fundamentally dishonest. Over 1 in 10, 13%. Another study down here in the green highlight, about 21% of employees are honest, but 66% are encouraged to steal if they see others doing it without repercussion. Let's read that again. This says about 21% of employees are honest. Only 21%. But 66% of employees are encouraged to steal if they see others doing it without repercussion. So this is why fraud needs to be identified, and if it is identified, it needs to be, the investigation needs to be handled correctly so that everything can come to light, and you need to pursue later on some kind of action against the fraudster that will see that others, again, saw the repercussion against the one that actually did it, and hopefully it will prevent them from committing some act of fraud. So, look at these numbers. I mean, they sort of are far apart, but you can see at least 13% are dishonest. This next one says 21% are honest. There's a big gap, in the middle there. Next page. What fraudsters will do? They'll start out in baby steps. Like, for example, one of my credit cards was compromised a number of years ago, and the credit card company called me up one day and was asking me about some purchases. And they asked me on, one of them, they said that I had two of them compromised. One of them, they said, did you just make I think it was a $2,700 purchase at a department store in Denver? I thought, no, I'm here in Kentucky. You haven't been to Denver in many years. I said, okay. A couple of days earlier, did you make I think a couple $100 purchase in New York City? No, I wasn't there. Another credit card several years later was compromised, and again the card company called me up and said, did you just purchase a $1,000 one-way ticket from, I think it was Miami to London, England? I said, no, it wasn't me. They said, did you make a purchase either that same day or the day before of just a couple of dollars, maybe $4, $5, or $6 of something in a store. I said no. What they did here, they were testing the card, taking a baby step at first. Does this card actually work? The numbers I received somehow, they were stolen. Do they work? Made a small purchase. No red flags were raised in the credit card company's computer. And so then they went with the big purchase. You know, that huge department store purchase in Denver, or the one-way ticket for $1,000 to London, England. So fortunately, you know, I didn't have to pay for it, but we had to cancel those cards and get new cards for me. So baby steps in a company. People will try a few little things. They might get by with it. Then they'll go a little bit more, maybe a little bit higher theft, and they'll keep getting higher and higher. So as a fraud investigator, you need to remember, fraud is accumulative, which is another reason that materiality is not appropriate for a forensic audit. So in a forensic audit, unlike a regular financial statement audit, a forensic audit, one very, very small discrepancy, you know, I don't really want to say an error. An error, you can go back and hopefully, you know, find that it was actual error later on. But anyway, small things you look at. You don't think, oh, it's immaterial, let's don't worry about it. No. For a forensic audit, everything you find that is not appropriate, you need to justify in your mind, you know, was it just an error, like I said before, or is this something that might lead into a bigger fraud? Okay, let's go to the next page. Let's see. More reports you can look at. And how can you be proactive? Okay, because you want to set up some systems, internal controls in the business, and you would like to hopefully prevent fraud. You know, so how do you do this? What you need to do in the first step, identify the frauds that may exist, you know, for that company in a particular situation. So not that there are frauds out there already, but you're trying to think what could possibly happen. In this company, in this situation, how could fraud exist? What are the possibilities? Let's set some controls up or some tests up to look for that. Number 2, formulate a null hypothesis stating that the frauds do not exist. So you say, okay, frauds don't exist. Let me see if that's true or not. Number 3, identify the red flags that each of the frauds would create. So again, if you're on a forensic audit, what would you be looking for? What are the red flags you would see? And then number 4, design customized queries to search for the specific red flags or combination of red flags. So design your test to find those flags you identified. Next page, what we got? Embezzlement. Now we're getting into various types of misappropriations. I'll just cover one or two of these. You all know about embezzlement, right? We've heard about it in the news and so forth. So you know what's going on here. You have an employee taking money or property from the employer. Okay? A lot of times it is cash. You know, the fraudsters love cash. So the embezzler steals from his or her employer. That's what embezzlement is. You read this first sentence I have highlighted, and it sounds a little bit strange at first. Embezzlement is the fraudulent appropriation of money or property lawfully in one's possession, and then they've appropriated it to be used personally by the embezzler. The reason they say it's lawfully in that person's possession because they work for the company. They have access to the cash account. They make deposits. They withdraw cash. They write checks. They have inventory in their department. So lawfully, you know, it's under their control. It's not theirs. So when they steal it, then it turns into embezzlement. Another one, you know, cash is a favorite target of fraudsters. You either want cash or you're stealing property that you want to convert to cash in most cases. Okay, so cash, you know, again, cash is king, as they say. Everyone wants the cash, right? So fraudsters are after the cash. What can you do to help prevent this? And the yellow highlight, segregation of duties, mandatory vacations, having 2 employees open the mail, and you can see the others. This is how you start setting up these internal control procedures, the controls that will hopefully prevent cash from going out the door. Now, larceny of cash, this involves numerous types of theft of cash after the cash has been recorded on the books. That's the larceny. It's been recorded in the books, and so that's considered larceny. Whereas skimming, I might have it in the next page, I believe. Let's see. Skimming's down here. Skimming is removing cash before it's in the books. Okay, so it's taken out of the checks they receive from customers, so it doesn't even get into the books. So that's the difference between skimming or larceny. Now, I've seen situations where the business owner himself or herself will skim cash out of the business. You think, why are they stealing from themselves? They're not. What they're doing, they're stealing from the tax authorities. They skim the cash out of the business, so they have the cash from the business, but they're not going to report that as revenue, so it won't be taxed on their tax returns. So that's another way of skimming, where the owner actually skims the money before it's recorded in the business, and that's for tax evasion. Check tampering. Heard about this a lot in the past. We don't have a lot of checks, at least I think as individuals, we don't write a lot of checks these days. Some of the few I write every year are like to pay for property taxes, maybe a few other things, association dues or whatever, but not a lot of checks. In the past, there were a lot of checks that were compromised, and it still happens, somewhat today, but I don't think it's as big a problem as it was in the past. Okay, let's see what else is next. Nothing here. Kiting. This happened a lot in the past because someone would deposit like a big check into a bank account. Well, that check was bad, and that person depositing it knew the check was bad. But the company would give them credit for that deposit until it cleared the banking system, what could take up to a week back in the old days. So now they have access to some cash that's not really there, but the bank gives them credit for it. And so then what they do, they'll write a check on that, maybe to cover the next bad deposit they made. So they start floating around, kiting the checks, and it's like a game they're trying to play, a juggling match, something like that. And so I think with the quicker check clearing services we have today, this isn't as big a problem, but it could be a problem. So a couple things you can look at for kiting schemes. You can read that. And let's see, nothing on this page. Let's see, we're at page 14, and so let's go to 15. Lapping. You hear about this from time to time. Money comes in the door to a business. An employee, opens the mail. They get the cash or the check. They take it themselves and don't record that as a payment of a receivable on their employer's books. What they have to do then, and this is where the lapping comes in, the next money that comes in the door, they apply that to the first one that was not applied to, that really paid. And so they're always behind in posting. So you've heard about that quite a bit over the years. And then the next one here, fictitious receivables. Now, receivables, just like inventory, are huge areas in business that you really have to watch closely. There's a lot of fraud involved with recording too much in receivables and sometimes too much in inventory, and also theft of inventory, where the balances might be recorded high, but inventory really isn't there. So all kinds of things can happen with receivables and inventory. We're on page 16. Just talked about inventory. Again, just all kinds of things can go on. Financial statement wise, for securities fraud, companies like to make inventories look better on the balance sheets than what it's really there. Maybe they've inflated the numbers, the value, or maybe the inventory just isn't there and they're just putting fake numbers in the inventory count on the balance sheet. So all kinds of things can go on with inventory. Other thing, short shipments inventory, partial shipments, they occur when payment is made in full to an outside accomplice and all the inventory did not come in. Okay. Other means, collusion may occur between receiving and delivery personnel, whereby a receiving employee signs less merchandise that actually came in the door. So all that didn't come in. What was all there, they took part of it, only said, well, this amount came in. And so maybe the delivery person and the receiving employee will now take that extra inventory they've sort of, I guess you can say, sort of skimmed off and try to sell it themselves and make some money. So inventory you really have to watch. And let's jump to, I think here we're going to jump to 23. I don't have time to go through every page, but let's look at this one. Walking the walk of fraud detection programs. So how do you stop, hopefully stop fraud, and then how do you find it and so forth. So 3 critical self-assessment questions an organization might address. Okay, so if you have a company and you're trying to show your employees fraud should not happen here, please do not think about it. So you ask yourself, is there a published ethics policy with definitions of fraud? If not, put that in the employee handbook. Is fraud included in the company's overall business risk assessment? You want to bring in, if you're the company owner, you want to bring in, these forensic accountants, auditors ahead of time and say, what should I do to help me prevent fraud in my company? Let's assess the risk. Is there a plan in place to respond to risk and to limit damage to the business? You got controls up, but then if there is something that happens, what are your plans? How do you handle it from that point on? And you have some organizations showing some other elements of a fraud risk program. I'll let you read that yourself. They also say that internal auditing should provide objective assurance to the board and management that fraud controls are sufficient. Okay. So internal auditing should have a large responsibility in designing these programs and helping locate fraud if it does exist. So we have a couple more highlights here about internal auditors, so please read that. There's 23, 24. Business policies, you want to set the proper tone. Again, making your employees aware, as the owners, we don't want fraud to happen here. We don't commit fraud. We don't condone it. That needs to be in your ethics policy. And they have a sample one here you can read on your own. That's 24. Okay, so 25. Sample rules of conduct. The following is listed improper performances as against the best interest of the company. So again, employees not being at their appropriate workplace, ready to work at the regular starting time, and failing to remain at such workplace until quitting time. So you want to have your employees there on time at the right spot. If that doesn't happen, that's improper performance. Of course, stealing, you don't want that to happen. Willful damage, things like that. Punching another's time card, if companies still have those. Okay. So read through these. Again, getting back into risk assessment should have 3 key elements here. Identify inherent fraud risk. We're going to see a chart in just a minute about this one. Assess the likelihood and significance of inherent fraud risk. Where are the areas in my business or the accounts in my records that might lend themselves, inherently lend themselves to risk being present? And then respond to reasonably likely and significant inherent and residual fraud risk. So 3 items to consider here. And the next one. Steps in a fraud risk assessment process. I'm not going to read all through these. Look at this yourself. Organize, determine, identify, and so forth. And look at this. EY, Ernst & Young, found that organizations that had not performed fraud vulnerability reviews were almost 2/3 more likely to have suffered fraud within the past 12 months. So if you don't assess potential fraud in your business, you don't have that policy, ethics, 2/3 more likely you're going to have fraud. So again, set your policies, let your employees know. Still, after letting them know about your ethics high levels, still have those internal controls, assess the risk, plan for it to possibly happen so you'll know how to prevent it, hopefully before it happens, or catch it, identify it, not too long into the fraud process. Okay, this is one I was talking about earlier, inherent fraud. Look at like cash and cash equivalents. Of course, cash, people want cash, right? But only very few people really have access to the cash in the business, whether the actual cash, deposits, withdrawals, petty cash, or checks and so forth. So as a percent of total, only 6%. Impact on financial statements. Even if there is fraud involved with cash, it's only like a medium impact here. I'd say medium to light probably, compared to the overall, other kinds of financial statement fraud that could happen. The characteristic of cash, though, there's a high likelihood or high risk, because people want that cash, and someone learns that they have access to this cash, they think they can hide if they steal. High possibility that there could be risk here with the cash. Business process characteristics, actually, paying for your expenses, receiving cash from customers, medium risk here. Fraud risk is high with cash. External factors, other companies might try to get cash from you, other people through false invoices they send to you or whatever. Overall ranking for cash, high. And you can look at these yourself. These E/O and so forth, they're identified right here. But you can go down the balance sheet and see which areas have high risk, medium, or low risk. All right, let's see where we are. Okay, you can look at this yourself and this one. And let's see, 31. I need to go back to 30. 1 second. Go back here at the bottom, right here. Two types of major types of fraud investigations. There's reactive and proactive. Proactive, let's get ahead of the game, hopefully stop it or lower the amount of fraud that happens. So, number one makes sense. Effective internal controls. Financial operational audits. Intelligence gathering. Logging of exceptions. Something happens that is an exception to the internal controls. Log it. Look into it. Reviewing variances. Next page. Reactive. Investigating complaints and allegations. So here you're trying to find out, well, all right, did that happen? Did something happen? Intuition. You think maybe the numbers don't quite look right, possibly. You just have that feeling something is wrong, and so you check into that. And suspicion. All right, so let's say you find fraud. Okay, you have evidence of it. You know it exists. What are your first steps? As the owner of the business or the CEO, what do you do? First of all, number one, very first thing, call legal counsel. If it's fraud, it could be prosecuted criminally against that person. So you need to make sure every step you do to identify the fraud, find out how it was done, by whom, and so forth. Legal counsel needs to guide you. You want everything you gather to stand up in court. So call legal counsel, very first thing. Second thing, get your insurance carrier involved. You think, well, why insurance? Maybe later on, way later on after the fact, I'll see if insurance covers it. If you have insurance coverage on fraud, whether it's theft of your property by outsiders, employee embezzlement, things like that, Your insurance, you have to look at the policy. It might stay, your policy might state within a certain number of days. It could be days or a week or so. You must let the insurance company know from the time you suspected it sometimes or found it. Look at the wording. And if you don't report to the insurance company within that period of time, it's not covered. So you thought, I have loss insurance and I know what's going on. I'll report that maybe a month or two from now. It might be too late. You were covered if you had reported it to the insurance company immediately. They will help guide you through the process of identifying it so that they will be satisfied and be able to make the payment to you. Third step, make immediate steps to safeguard existing assets. You don't want to keep losing assets. So do something to safeguard your assets. Then quietly and confidently gather evidence. And then you got a lot more down here through 9. And you have to be careful because if you are investigating fraud, if the person who committed the fraud finds out you're investigating, they could delete information, destroy files or whatever. So you have to be very, very careful here. You want to limit future losses. And so if you're letting them continue in their position while you're investigating, again, you have to assess what's the fairly immediate risk of losing a lot more of my assets, compared to letting them know right now, the fraudster, hey, we're taking you out of that position. We think you committed fraud. So look at the other steps 5 through 9. And then what happens? What happens when fraud is found? What are the outcomes? KPMG found disciplinary action 54% of the time. We are going to demote you. Resignation, voluntary retirement is here. Maybe if this is a firing offense, depends on the severity and so forth. Enforcement action, you get the legal and police involved, 45% of the cases, 17% on the resignation, retirement, settle out of court, 6%, no action of sanction, 3%. No action might be, it was so small, you do not want any publicity on this. You'll just tell the person, we know you did it, quit doing it. So again, something to consider. And we're at page 33, okay, down at the bottom here. Now, companies on the front lines in preventing employee fraud. Here are some principles companies should employ. Maintain a fraud hotline. If someone else in your company sees fraud going on, can they report that without giving their name, a hotline, and say, here's what's going on? So have that a hotline everyone knows about and can use fairly quickly. In your company, have a mandatory vacation policy. You must take vacations. I've heard stories over the years where the person committing the fraud was thought to be the best employee in the business. That person never took a vacation. Well, they had to be there to cover up their activities every day. So force vacations. Rotate assignments of employees. And then, you can look at the rest of the list yourself. And some more items here you can look at. Rigorous accounting practices, bank reconciliations at least. Audit procedures. You can see a list here. I'm not going to read through these. Look at that. Red flags. Okay, so you're searching for fraud symptoms. Maybe you don't know if there's fraud yet, but what would be a red flag to make you think, oh, fraud does exist. Let me look at that item closer. Okay, a forensic accountant or auditor may have to search numerous documents. And what would you search? Look at canceled checks. Look at bank statements, time cards, contracts, invoices, shipping documents. Look through these and see if you see anything that looks unusual, out of place. Could be a red flag. And a lot of others, look through all this. More red flags. Employee acts unusually irritable. Start spending lavishly. Look at that new car, a very expensive car out in the parking lot, and you can read down through the others. Lots of things you can look for here. Not-for-profits, governments, government body, fraud exists there also. And so when you look at not-for-profits, the following practices under which unsuspecting not-for-profits can fall prey to fraud. Well, they don't have any procedures to detect or report unusual payments. Increased amounts owing to creditors. And you keep going on and on and on. A whole list of things. No audit committee. No formal external audit at all. These are situations where fraud very well could arise in a nonprofit organization. State and local governments. Corruption and incidents of fraud are much greater in the public sectors than in private industry. Why? Because people are not dealing with their own money. So it's not a business where you have an owner. It's not coming out of the owner's pocket. It's just coming from the government. I don't feel as bad about taking that money. So PwC's 2011 Global Economic Crime Survey. Look at this. Government and state-owned enterprises, 37% fraud. Listed on the stock exchange, 31% involved in fraud. Private sectors, 28% involved with fraud. Okay, so look, the government and state-owned enterprises, on average, have more fraud. More of those entities are hit with fraud than these others. Okay, so the Green Book, examples of control activities. Read through this. You have top-level reviews of actual performance. Reviewed by management at the functional or activity level. Management of human capital and the others. So what can government units do? There is this Green Book out there that says here are steps you can take to hopefully prevent fraud. Okay, what else do I have highlighted? Assessing financial health of governments. This area, okay, you really need to read this close. You really need to. We have some new formulas coming up here. What are some early warning signs of possible trouble for municipal entities where they might have a current year operating deficit, 2 consecutive years of operating fund deficit? And you can read down through the others. Talk about short-term interest and so forth. Property taxes greater than 9%. So you start to hit limits on what you can obtain tax-wise from the public. And so what they've come up with is, here are some indicators. Here are some new ratios that you can use to check the numbers in an entity and say, are we bumping up against something that's going to be like a red flag, something that will cause us worry, and there could be something going on in the company, and that's why the numbers look like the way they do. Okay, I'm not going to take the time to go through all these here. Go back and if you're not familiar with governmental accounting, and I'm not an expert in governmental accounting, some of these terms might sound unusual to you because we're getting to per capita, dealing with financial numbers. We don't hear that in regular businesses, but revenues and expenditures per capita. You have a couple of formulas here. Recurring revenues per capita. What is a negative trend in this area? Indicator B is increasing faster than indicator A and C. So compute these and see if it's a negative trend. Property taxes receivable, real property tax receivable. So divide real property taxes receivable by real property tax revenue. What would be a negative trend here when you look at it accounting period after accounting period? Percentage increases over time. You're not collecting that revenue, and you should be. Those are just two formulas. I have a whole list of others here. We're talking liquidity, unreserved fund balance. That's a real government accounting term. Capital outlay, intergovernmental revenues, public safety, debt limit exhausted. Look at all these. You'll have this available for the exam, don't worry. You will have to compute some of these numbers for the exam, but you can use these formulas. These are one of the pages I have that you can have access to during the exam. But one thing I want to point out, this is a page full of formulas. Go to the next page. You must read all the notes there, because these notes here are explaining what's happening back in some of the formulas. So they don't go together. Don't just go to these formulas and stop. So if you have this, like this asterisk here, you need to go back to the notes, find what it's talking about, the first one, and something like, some analysts use a variation of the 3B ratio based upon debt service expenditures as a percent of revenues. A ratio of 25% for debt service expenditures to own source revenues is considered a danger signal. Okay. So make sure that you read these when you look at those formulas. That's page 44. Don't have too many more left here. Let's go, next page, 46. I had something here. When do you call them professionals? Well, when someone decides you need them, whether it's management calling them in, something is found on an external audit, then you need to call in the forensic professionals. Okay. Sometimes you might bring a forensic accountant along on the external audit to check a few things, maybe during the initial stage of the audit. If that person finds something, then maybe they can start a forensic investigation if the company allows that. And what are the things to look for? This is a big thing. Something as simple as this would really catch a lot of frauds. In fact, it caught WorldCom. Inappropriate journal entries. So, okay, well, what are we looking for? Entries made to unrelated, unusual, or seldom used accounts. Trying to hide, or the debit and the credit, those accounts don't make sense tied to each other. Entries made by people who typically do not make journal entries. Does the CFO usually make a journal entry? No. It's someone working in that department a little bit further down the line. Recorded at the end of the period or as a post-closing entry that have little or no explanation or description. Perfect WorldCom example. End of the period, just after the end of the period, we need net income of a certain amount. Well, let's make some entries. No support, like the first one here. No, let's see. Oh, here it is. No explanation or description. Yeah. No support. Just make an entry. It's just sitting there all by itself. And made either before or during the preparation of the financial statements that do not have account numbers. Okay. Contain round numbers or consistent ending numbers. So things to look for. Just going through journal entries, especially close to the end of the year. Okay. All right, page 46, and one more page for us to talk about. Again, you're trying to find that elusive fraud, and so you might need to, have steps in the traditional audit. You might expand the investigative audit inside or out, with an inside or outside forensic accountant. So internal auditing, or bringing someone from the outside to look at something deeper. So what are 7 investigative techniques? You can look at that. Account records, trace funds, research the background and search for assets, develop confidential sources, I guess, within the company, interview, interrogate persons, and find witnesses. So this is where you're going deeper down, and you're trying to find difficult to locate information. All right, so we're towards the end of the chapter. It's another long chapter. I'm going to stop here. Again, this is not in placement of you reading the chapter in detail yourself. You need to do that. Okay, read it a couple of times. And go back to those formulas, work with them, look at them, read them very closely to understand them a lot better. All right, that's it for this chapter, so good luck with your studies.